Could the tide be turning for Singapore REITs? Real estate investment trusts have underperformed in the first months of 2024. Higher interest rates have weighed on share prices and valuations. But the sector still managed to chalk up an average dividend yield of about 7% over a 12-month period to February 2024, and prices are attractive.
You've got to take into consideration why that is at 7 to 8%. Basically, most of our REITs are trading at a 25% discount to book value. They're also trading at a 25% discount to the 5-year average book value. The DPU has been challenging because you do have higher financing costs. Those higher finance costs can cut into DPU, but you also have utility charges, which has been higher on the back of general inflation.
The second half of 2024 would be better. This is not like a blind optimism, but centered around a few key reasons. I think first, there is a broad consensus that interest rates have peaked. Second, valuations have become a lot more attractive after the last few months of correction.
REITs are financial products that allow investors to put their money into the real estate sector without having to buy or manage physical properties. They're popular with investors because they offer attractive dividend yields compared to alternatives like government bonds and fixed deposits. REITs can include retail, office, data centres and hotels. So which subsectors are set to give you the best bang for your buck in 2024?
I like REITs that have structural demand. They're able to grow and withstand against a recessionary pressures. They're able to do well, quite independent of the interest rate environment. So one example would be data center REITs because of the structural growth in digitalization and structural and generative AI like a demand. At the same time, I also like logistic REITs. I think logistic REITs are able to benefit from growing penetration in e-commerce and the growing need for companies to build supply chain resilience.
Other subsectors poised to do well include certain REITs in the retail space.
I think non-discretionary retail stands out for the resiliency of its underlying operations. I think many of us go to malls and it's always very crowded, right? In the crowded situation that we experience firsthand, it's really reflected in the underlying strong operating matrix.
High rents and strong demand for Grade A office space will also benefit office REITs.
Usually better than expected Grade A prices is a reflection of stronger fundamentals, and this would translate into profits and dividends. Also, I think another point to note is that for a lot of this REITs, right, they have exposure. When they have exposure to this high quality Grade A offices, they can then recycle their capital by selling off some of their assets in Singapore and redeploy them to places like, say, Japan and Australia, where it may be impossible to make yield accretive acquisitions.
Currently, the segment of REITs that have exposure to Singapore office properties are actually offering the highest dividend yields, but at the same time trading at price to book ratios that are lower than their peers. For the office REITs, these include Keppel REIT, and they also include, for the diversified REITs, CapitaLand Integrated Commercial Trust, Mapletree Pan Asia Commercial Trust. You also have Suntec REIT, Lendlease Global Commercial REIT, and OUE REIT.
According to RHB Singapore, a rebound in tourist arrivals could see hospitality REITs shine.
We like industrial and office sectors, most preferred sectors, followed by hospitality. And we are slightly more neutral in terms of the retail sector. The hospitality sector, I think, definitely has seen a strong start to the year. I think visitor arrivals for the first quarter is up about 50% year on year, and it is now close to 93% of the pre-COVID levels in the first quarter.
According to market watchers, investors should take a cautious approach when considering REITs with overseas exposure.
There is no specific sectors we tend to avoid, but what we would say is that overseas markets tend to be a bit more volatile at this point of time. So if investors want a relatively stable And defensive REITs, I think Singapore-centric REITs and large cap names are the ones which are more preferred compared to that of smaller mid cap and overseas names at this point of time.
When picking a REIT, look out for these key indicators.
Pay attention to the underlying dynamics and structural supply and demand of the REIT, and also question a bit more about the impact of dividends in terms of making sure that the dividends are sustainable. At the same time, it's also useful to think in terms of who are the sponsors of the REITs that they want to buy, because a strong sponsor will allow a REIT to grow its revenue more efficiently.
The key metrics investors should look at this point of time would be gearing levels. Definitely REITs below gearing of 40% would be a lot more stable in this rising interest rate environment. So gearing is basically total debt over total assets. And the other factors that investors can look at is a defensive cash flows and a diverse profile, which can help them in the current uncertain environment.
One risk that investors should pay close attention to, the impact of high interest rates and foreign exchange fluctuations.
We've started the year very concerned about interest rates, but I think we might end the year a little bit more concerned about exchange rates, because our REIT hub is an international REIT hub. So what the US dollar actually does have a ripple effect through many economies and countries that these REITs have exposure to.
Recently, the Sing dollar has been very strong. So when it's translated, when foreign distributable income is translated back into Sing dollar terms, that maybe lead to a bit of a decline.